Hey everyone, John AG here. Before we dive into today's numbers, I need you to do one thing. Scroll down to the comments and type 2 words. Currency archive. That's it. Just currency archive. It's how I know this message is getting to the people who actually want the truth about what's happening in the markets, not the cleaned up version they show on TV. Type it now. The crash happened. Let's look at what just went down. In less than 48 hours, silver went from $96.40 all the way down to $78.06. That's a drop of more than 19%. In that same crazy session, the Dow Jones took a huge hit, the US dollar shot up to its highest point in 6 weeks, and a key inflation measure, the ISM Prices Paid Index, hit its highest level since June 2022 at 70.5. This inflation scare instantly killed any hope for interest rate cuts. So what happened in silver? When prices started falling fast, it triggered something called margin calls. Big leveraged traders had to sell, and that selling pushed silver down past every safety net, all the way to its 200-day moving average at 87.69, and then even below that. But here's the crazy part. By Wednesday, March 4th, just a day later, silver had bounced back up to $85.64. A major dealer like JM Bullion was asking $86.77. That bounce was real, and it's telling us something important. None of the real-world problems that caused this got fixed. Not one. Let's go through the numbers that matter. Everything you need to understand where silver is going next is in the data that gets published every single day. You just have to know where to look. Start with the COMEX silver inventory. This is the silver that's set aside and can be used to deliver against futures contracts. On February 9th, that registered silver sat at about 102.2 million ounces. Fast forward to March 3rd, and it had fallen to just under 88 million ounces. That's a massive 14.2 million ounces drained from this critical category in less than a month. That's nearly 650,000 ounces leaving every single day. This is the only silver that can be legally promised against a futures contract. The total amount of silver in all COMEX vaults, both registered and eligible, was 355 million ounces on March 3rd. Back in October 2025, that total was 532 million ounces. That's a 1/3 drop in just 5 months. This metal isn't just being moved around on paper, it is physically leaving the vaults. They are emptier. To show you the stress this is causing, look at the March delivery month. COMEX had to deliver over 52 million ounces of silver just in March. That's over 10,000 contracts. The very first day for deliveries was February 27th, and by March 3rd, over half of those contracts had already been turned into physical metal. The pace of people asking for real silver, not just paper promises, is unlike anything we've ever seen. And now, look at what's building for May. On February 27th, the May contract had about 78,800 open contracts, representing a claim on 394 million ounces. By March 3rd, that number didn't go down. It actually grew to 80,274 contracts. That's over 401 million ounces of paper claims. Let that sink in for a second. 401 million ounces of paper promises for May, sitting on top of just 88 million ounces of actual physical silver available to deliver. The first day to demand delivery for the May contract is April 30th, 2026. That's just 57 days from now. Between now and then, everyone holding a May contract has to decide, do they roll their bet to July, sell and get out, or do they demand the physical metal? To understand the pressure, look back at January 2026. About 62% of contracts that could demand delivery did. In February, that number was lower because prices had peaked, but the underlying tension that caused the January rush, it's still there. In fact, it's worse. The registered inventory is lower, the physical market is tighter, the cost to borrow silver is higher. Let's do the math. If just 10% of the May contracts demand real silver, that's 40 million ounces, almost half of all the registered inventory. If 15% demand delivery, that's 60 million ounces, or 68% of what's available. If 20% stand for delivery, that's 80 million ounces, gobbling up 91% of all registered silver. And if 25% of the contracts ask for the metal, the registered inventory is completely wiped out, and there are still contracts left unfulfilled. These aren't crazy predictions. We saw a rate near 60% in January. Even a much smaller number in May would put COMEX in a position where it has to do something that's never happened before in modern times. Find silver from other categories, stop deliveries altogether, or pay huge cash bonuses to get people to accept money instead of metal. Any of these outcomes would cause a price explosion that we can't predict from past charts. Now let's talk about China. This is the other half of the story. A top analyst, James Henry Anderson, reported on March 4th that silver stocks in China's main exchanges have fallen to just 752 tons. That's about 24 million ounces. He called it the lowest level in a decade. His conclusion was simple. Either the price of silver has to go way up to attract more metal into China, or the Chinese government will have to stop allowing silver to be taken out of its warehouses. Those two sentences explain the whole problem. Physical silver doesn't just appear. At some price, people will sell. The question is, what price? If China's vaults have only 24 million ounces left, and their industries, think solar panels, EVs, electronics, use about 230 million ounces a year, that stockpile is only enough for about 5 weeks. That's not a buffer. That's the absence of a buffer. Bloomberg and ING both confirmed last year that Chinese stocks were at decade lows. What Anderson is reporting now is that the drain has just gotten faster. In early March, silver in Shanghai was trading at a 17% premium to the price in New York. When the exact same stuff costs that much more in one place than another, it means the normal system of moving metal to cash in on the price difference is broken. Moving silver from New York to Shanghai is the logical thing to do, but it's hard. China made it even harder by putting new export rules on silver in January 2026, affecting 44 major companies. Let's be clear about what China did. They set up a licensing system that blocks smaller companies from exporting silver. They slashed the number of futures contracts anyone can trade by 73%, and they stopped new investments in several silver and gold funds. These aren't normal market moves. This is a government treating silver like a crucial resource and keeping it inside its own borders. China produces about 17% of the world's silver. By restricting its exports, they're cutting off a huge source of supply that the rest of the world, including COMEX, has always counted on. Anderson also asks a really important question. Since February 9th, regular retail investors sold about 15 million ounces of silver through big ETF funds like SLV. Overall, silver ETFs lost about 42 million ounces from their peak in December. Here's the key. That selling did nothing to help the physical market. The cost to borrow silver didn't go down. The warning signals in the futures market didn't go away. COMEX registered inventory kept falling despite all that metal being sold. If selling 42 million ounces of ETF shares can't calm the physical market down, what happens when that selling stops and turns back into buying? Anderson's point is direct. When retail starts buying back even 15 million ounces through SLV, it tightens the market instantly. To create new SLV shares, the fund managers have to go out and find physical silver to put in the vault. And right now there isn't much to find. And guess what? The buying is already starting. SLV reported over $175 billion in new money coming in over the last 30 days. Retail is coming back, treating that drop to $78 as a huge opportunity. In fact, right now, SLV shares are trading at a nearly 5% discount to the value of the silver they own. In a normal market, that gap gets closed instantly. The fact that it's still there means one of two things. Either the big firms can't find enough physical silver fast enough to create new shares and close the gap, or the risk of trying to find that much silver is just too high. Both are incredibly bullish for the real price of silver. Now let's look at what's called the swap rate. This number tells you who really understands this market. On March 3rd, the one-year silver swap rate was negative 2.97%. To get this, you have to understand how pricing normally works. In a normal market, the price to buy silver a year from now should be the current price plus the cost of storing it and the interest you lose by holding it. That should make the future price about 4% to 5% higher than today's price. But right now, the market is pricing silver for delivery in 1 year at roughly 7% less than what the math says it should be. Why? Because people are so scared they won't be able to get physical silver 12 months from now, they're willing to pay a huge premium today to lock in a price for future delivery. That negative swap rate is the market literally putting a price on the risk of a physical shortage. This isn't a small blip. It's the clearest sign yet of how tight things really are. One analyst, Carol Merks, who has watched this for years, said that the current cost to borrow silver for 1 month, around 3%, is by itself enough to know that a new all-time high is just a matter of time. For 5 years, from 2019 to 2024, that cost averaged negative. The current rate is more than 30 times higher. For that cost to go back to normal, several things would need to happen. COMEX registered inventory would have to refill. The May delivery pressure would have to vanish. Chinese vaults would need to restock. None of that is happening. Look at the futures curve. It's backwardated, which is a fancy way of saying future months are cheaper than the current month. May futures at $83.47, July at $84.82. That difference is negative. In a normal world, future prices are higher because you have to pay for storage. When they're lower, it means people are desperate for metal now and will pay a premium to get it today rather than later. This backwardation has been here for months. It didn't go away during the crash. The price drop to $78 didn't magically create more physical silver. The desperation stayed. Let's put this all together. On February 9th, there was a gap of over 260 million ounces between the paper claims and the actual silver available. That gap was supposed to clear by March 5th. March 5th came and went. Now the May contract is carrying that weight. 401 million ounces of paper open interest, 88 million ounces of real silver, a 313 million ounce gap. And that gap assumes no new buyers show up between now and April 30th. Remember those 42 million ounces of silver that retail sold from ETFs? That should have reduced the pressure. Instead, the market got tighter. COMEX registered fell by 14 million ounces. The cost to borrow stayed high. The warning signals stayed red. What that tells us is that big institutional players, names like Bank of America and Citi, absorbed every ounce that retail sold and then some. Retail sold paper. Banks took physical. The total silver available didn't increase. It just moved from one vault to another. It became more concentrated. Now, as retail starts buying again, they'll be competing for that same physical supply against big institutions that are holding tight and won't be selling. The May contract is the next big test. April 30th is the day of reckoning. All 401 million ounces of open interest have to be dealt with. Some will roll, some will close, but some will demand metal. The percentage that demands delivery is the only number that matters for the price of silver in May. Based on everything we've seen, the lease rates, the swap rates, the backwardation, the Chinese vaults, the actions of the big players, there is no reason to think that percentage will be normal. 828 million ounces in ETFs are held by people who bought higher and won't sell for a loss. 88 million ounces in COMEX registered is 47% lower than it was just a few months ago. Borrowing costs are at 30 times the 5-year average. Swap rates are negative for the first time in history. Chinese stocks are at a 10-year low and still dropping. In May, open interest is growing. Silver at $85 on March 4th isn't cheap in dollar terms. It is incredibly cheap compared to every single signal the market is screaming at us. Gold is at $350. The gold to silver ratio is now about 63 to 1. Back in January, when silver hit its all-time high, that ratio was 45 to 1. If that ratio returned to 45 to 1 with gold at today's price, silver would be 118. If the ratio was 55 to 1, silver would be $97. The market was at $97 just days ago before the crash. The crash didn't change the gold price. It changed the silver price by 19% without changing a single ounce of physical supply or demand. Anderson's bottom line is direct. No matter how you look at it, the price of silver has to go higher. A 3% cost to borrow is only consistent with silver hitting a new record high soon. A negative swap rate is only consistent with a market terrified of a supply crunch for the next 12 months. The backwardation is only consistent with an urgent need for physical metal that record deliveries haven't satisfied. None of this means silver goes up tomorrow. The paper market can get whipsawed by the dollar, by rate expectations, by margin calls. The crash from $96 to $78 proved that. The question isn't whether silver is cheap based on its real-world fundamentals. It clearly is. The question is, what event finally forces the paper price to wake up and see reality? May 1st notice day is April 30th. The answer to that question arrives in 57 days. Let's go deeper into that lease rate. From Feb 9th to March 3rd, it fell from 2.84% to 1.72%. A falling lease rate looks like good news, but you have to understand why it fell. In late January, when silver hit its $121 high, the lease rate was an insane 7% to 8%. Then the CME raised margin requirements. Leveraged traders were wiped out, and silver crashed 33% in one day. The lease rate fell not because physical silver became easier to get, but because the number of people desperately trying to borrow it fell after the crash scared them away. A lease rate that falls because buyers got knocked out is not a market getting healthy. It's a bruised market. The core problem never went away. The spread between May and March futures stayed consistently negative throughout February. It didn't matter what the price did. The structural backwardation is anchored in physical reality. Speculators can come and go, but the backwardation is the market saying, I need it now. The negative swap rate is the same message, just for a longer time. It's the market paying a huge premium to guarantee they have metal a year from now. This premium stays because the structural deficit is real and it's not going away. The Silver Institute thinks we'll have another deficit of 67 million ounces in 2026. This will be the 6th year in a row. Since 2021, the total deficit is around 820 million ounces. To put that in perspective, that's the equivalent of every single ounce of silver mined in the entire world in 1 year. All gone, used up, and those stockpiles aren't being refilled. The biggest reason for this is solar energy. In 2025, solar panels gobbled up about 230 million ounces of silver. Every solar panel needs silver for its electrical parts. The global energy crunch, with problems in the Middle East, is only making governments push for even more solar, faster. More solar means more silver. Same for electric vehicles, AI data centers, and all the new defense electronics. This isn't speculation. This is mandated by law, built into contracts, and physically using up silver at a rate mines can't match. Think about the China scenario again. What if they do halt silver withdrawals from their warehouses? That's not a small thing. China makes about 17% of the world's silver. If their stocks get too low, they will lock them down to protect their own industries, just like they did with rare earths. If they formally stop withdrawals, that's another 24 million ounces that the Western world thought it might be able to get, suddenly and completely off limits. The signal that would send to prices here would be huge. Anderson's other idea, that prices must go high enough to attract metal into China, has a different problem. Mines can't just turn on a switch. It takes 7 to 15 years to open a new mine. Scrap recycling can help, but not overnight. By the time new supply could arrive, the years of deficits will have eaten up whatever was left. The COMEX stress index, which tracks all these factors, is at 79 out of a maximum of 88. It has never been higher. The old record was 64. That means the paper market and the physical market are more disconnected than they have ever been. The paper price is down almost 30% from its high, but the physical stress is up 23% from its old record. That's the definition of a disconnect. The paper price is about what leverage traders can handle. The physical market is about where the metal actually is. This gap cannot last. In every major commodity crisis before this, the final answer was always price. Price went up until it either brought in new supply or made it too expensive for some people to buy. For silver, the industrial demand isn't flexible in the short run. A solar panel maker can't just use something else. So the price has to do all the work. It has to go high enough that companies start designing silver out of their products, that recycling surges, and that people holding silver bars decide to sell. That process takes years. In the meantime, the market runs a deficit and the physical inventory drains. The $78 price on March 3rd wasn't a sign of a weak market. It was a sign that paper silver can be sold much faster than physical silver can disappear. The physical market doesn't move that fast. It updates in daily reports, not minute-by-minute ticker tapes. The paper market panicked and repriced 19% in 2 days. The physical market, it was exactly the same as it was before the crash. 14 million ounces drained in 3 weeks. Swap rates at -3%. Lease rates at 30 times normal. Chinese vaults at a decade low. Silver is at $85 on March 4th. May 1st notice day is April 30th. There are 401 million ounces of paper claims chasing just 88 million ounces of real metal. The cost to borrow silver is still at historic highs. The swap rate is still deeply negative. The futures curve is still flipped upside down. Retail is starting to buy again. Chinese inventory is still falling. In 57 days, the biggest pile of silver futures contracts in recent memory hits its delivery day. Every single number points to the same conclusion. The paper price and the physical market have never been this far apart. One of them is wrong, and the data is telling you which one.